So last Friday's jobs report completely flipped the script on September 17th potential rate cut odds. We went from 23% odds literally a few days before this to 86% odds that the Bank of Canada is going to cut rates at least 0.25% over the course of just 72 hours. If you're waiting to see what happens, you just missed the biggest signal I think you're probably ever going to get. Most people are still trying to figure out what the jobs data actually means and how this is going to impact the marketplace. So I'm going to show you how this completely changed absolutely everything in literally just a few days, and why the next 2 weeks could actually be pretty critical for your mortgage strategy moving forward. Now, before I get into that, just a week ago, if you haven't checked out my last video, I talked explicitly why people are wasting time by waiting until September 17th's rate cut. I still believe that this is the case, but for completely different reasons. Let's get up to date on why this current data matters for you and how it's going to impact your mortgage. All right to the point. The data, the news. Canada lost 66,000 jobs in August, which the street expected us to gain 7,500. That is a massive swing, almost 60,000 jobs in the wrong direction. And here's the crazier thing. White collar jobs got completely obliterated. Office towers, they shed 26,000 positions. Please shed a tear for our office workers. Some of that, yes, was led by AI and technology, and in other places was just a loss of overall jobs based on the economy not doing as well as it has been in the past. This has led to the probabilities of rate cuts completely changing and exploding from 23% to 86% in just a single day. Here's the thing. This wasn't a small miss, as I mentioned. This was an economic, basically, earthquake. When economists are like expecting one thing and then the reality delivers a completely opposite, the markets don't just react, they freaking panic. With regards to the job losses, these aren't minimum wage jobs that are disappearing. And that is the highlight of this conversation. These are people who qualify for mortgages. These are people who buy homes. These are people who drive real estate demand. And over 26,000 of these guys just got the pink slip. Not something to joke about, laugh about, but it is a serious impact to the economy. And the market react pretty wild. Bond traders, they don't get very emotional, as you may know. But when they see data this bad, they do start pricing in emergency reaction from the Bank of Canada. Now, to take a step back, typically we talk about the fact that the BOC and the bond yields don't always drive each other in concert. One is usually a reaction to the other. And in this case, this is a reaction to information before the BOC's announcement, which means that anything that is going to happen is probably going to get priced in now, not after the BOC's announcement. So fixed rates, the reductions that might be coming, which I'll talk about if they do, are going to be priced in now. So let's talk about the data on this and just, again, breaking this down. The supporting data showed that unemployment is at 7.1%, which is the highest since 2016. We talked about the 26,000 office job losses, and the bond yields, which can typically have an impact on fixed rate loans. It was down 0.8% as of Friday, September the 5th. Pretty substantial. By the time you're listening to this episode, it might have changed slightly, but that's where it was at that time. Really, the key to this is that this is a worried market. This is a market that is very nervous about where things are going. Throughout the reading on this material, there's a few key points that I really need to nail home. The first thing is we didn't just miss expectations. We completely obliterated the job expectations. This wasn't just a factory floor carnage. I mentioned the white collar jobs just got completely decimated. The prime age of unemployment jumped to 6.1%. I can't understate the fact that these are people who have homes and have mortgages that are getting their jobs, that are losing their jobs. And that is going to have a significant impact on the real estate market. When I say that we obliterated expectations, here's what I mean. It's like showing up to a party expecting 10 people and finding 60 people already left. The economy didn't just underperform, it moved in the complete opposite direction altogether. Manufacturing jobs, they typically, historically speaking, disappear in recessions, and that is normal. But when office jobs start vanishing, that's the mortgage market right there. These are university educated professionals with benefits, steady income, families, and it's the exact type of person that the real estate market actually depends on to be either buying homes and or taking out mortgages. People that are between the ages of 25 to 54, which are considered prime age workers, carry the biggest mortgages. They're the ones who are buying homes, they're upgrading properties, they're driving the market. And when their unemployment jumps to 6.1%, you'll see the lenders start to be sweating. And best believe what that means is that you're going to see lenders tighten up their guidelines and get a little bit more nervous about lending money as part of this big picture. And that's a thing that nobody is paying attention to. Now, TD called this, Andrew Kelvin at TD called it putrid. And the fact that we saw such a significant change on both sides of the border, hemorrhaging jobs, means that the central banks on both sides, the Fed and in Canada, basically must cut rates. And the markets, as I mentioned before, the markets got the message straight away. This is an economic emergency signal. And if they miss this, they're going to miss on everything. When both Canada and the US miss job expectations this badly on the same day, it's not a coincidence. It is a trend. The banks, Bank of Canada and the Fed, have one playbook when unemployment spikes. And while inflation moderates, they need to cut aggressively. And the market understands this stuff. Like, that's why we see the bonds rally and the rate cuts odds completely explode. Now, if you're wondering why the banks must cut rates on this, the Bank of Canada operates on two mandates. They keep inflation around 2% and they maintain employment. When unemployment jumps to 7.1% while wage growth drops to 3.2%, they don't hold committee meetings to debate. They have no choice but to act. Like, I am telling you this is the choice. Tiff has been forced, his hand has been forced. He's going to have to cut rates. Studying every Bank of Canada decision since they adopted inflation targeting in 1991, they have never, not one time, maintained restrictive interest rates when unemployment hit these levels with inflation under control. One bad month, that could be a statistical noise. 2 consecutive months losing over 100,000 jobs, this is an economic emergency that needs a policy response. Historically speaking, as I mentioned, the BOC always cuts when inflation is greater than 7%, when unemployment is greater than 7% and inflation is controlled. We talked about the fact that wage growth is down 3.2%, and the worst of it is in the Ontario area. Windsor at 11.1%, Oshawa 9%, Toronto 8.9%. The East Coast, or I guess you want to call it Central East, is getting decimated right now. With the U.S. also talking about cutting, this could be a position very soon where the BOC sees a need to cut rates. Now, we'll talk about where the rate market could go as I continue the video, because by the end of this video, you should know exactly what you need to do and where the rates could be going based on this data. But let's get into some of this right now. Manufacturing towns like Windsor and Oshawa, think about this. They're canaries in the coal mine. When they hit double-digit unemployment, it spreads to the service sectors. The Bank of Canada can't maintain a tight policy when their largest trading partner in the US is cutting rates. It would devastate the exchange rate and exports. Macklem has been cautious all year, but the economic data this bad, like, let's be honest, it completely forces his hand. He's got no choice but to move forward in cutting rates. Let's talk about this 86% probability and what it actually means for you. Why the cut? Why is the cut coming, and why waiting can be a mistake now and in the future? Markets don't wait for official announcements. Lenders are already adjusting their rate sheets based on this 86% probability, which means the relief that you think you're waiting for has already probably been caught in. Now, there's a few different ways that this happens. Number one, we just talked about what the bond market did right now, which means we could see an impact on the yields in the coming days. This could impact fixed rates, possibly. We'll see. We're heading into Q4, and in Q4, there's possibly less likelihood that the banks are going to be as aggressive. But what you'll notice is that what will happen on the variable rate side of things is the banks will be less aggressive on their discounts. So if you're getting prime minus 50 or prime minus 55 today, you might be getting prime minus 30 or 35 tomorrow. These lenders are looking at this from a big picture perspective, and they know that if the market's going to drop, they're going to reduce their discounts. And so for you waiting until September 17th rate sheet, if you're going to go variable, it's probably going to just cost you more money. And here's the truth, like for months, choosing a variable rate versus a fixed rate was literally a coin flip, if you will. Friday's data flipped the coin more decisively. If you can handle payments at 4.7%, you are positioned to catch multiple cuts through the end of 2025 and into 2026. There are expected cuts of between 2 to 3 more until the end of spring of 2025, with a suggestion that the rate path is going to go 2.75, which is today. That's the key rate, not the prime rate. So it'll go 2.75, 2.5, potentially 2.25, and then as little as 2 by the beginning or first quarter of 2026, which means the impact of prime would be 4.95 to 4.7 and 4.45, which is where you're seeing the discount. And this is where that question or conversation of fixed versus variable is changing. I am not going to tell you that I suggest that everybody goes variable because of this rate data. But I'm going to tell you that if you are thinking about going variable, then the coin flip has worked in your favor, and it is much more clear as far as a timeline at this point right now. So what that means is that with us already seeing on the mortgage broker side, like we're already getting rate sheets, like literally coming through the door as of Friday and then Monday. The people that are moving early are probably going to capture better pricing, particularly on variable rate loans, before everything becomes official on September 17th. They were quote unquote considered. We had an interesting year where we went from no variable rates and then everybody was taking variable and then nobody again. And now I think it's going to flip flop where everybody's going to go variable rate again. And I think that could actually be a mistake. I think people still need to use a proper framework in making a decision of going fixed or variable. But I think that the decision is made easier this moment with these odds. And obviously it becomes a little more of an obvious play for that person that's willing to play the marketplace and is looking for that flexibility. We honestly went from a hope to a perfect storm to expecting it as a likely outcome. Now let's do a little bit of a reality check on this whole situation. So I don't really like to deal with maybes or possibilities in any way, shape, or form. We want to be brutally honest about what the cut could mean for you. 86% market odds backed by the worst job data since 2016 is no longer a speculation. It's close to an economic certainty as you could possibly get. The only question is about the execution and not the outcome in this case. Everyone is quite literally focused on the rate cut itself. For me, that's an amateur approach because the real opportunity is acting on high probability information before it becomes universally known and priced in, which is basically now besides this point. However, a lot of people are not paying attention to this information that I'm sharing with you right now. You basically have 2 weeks while this information is known by the markets, but not yet acted on by every other buyer and investor. And that's your competitive advantage window in 2 different ways. I just shared with you the rate discounts changing. But the second thing is, and this really, this information I have to use with an asterisk and be careful with this conversation. But the amount of people that have reached out to me and said, I am waiting until September 17th before I buy a home or restructure or invest into that real estate. There's a lot of people out there, actually, believe it or not, who are qualified, who want to buy real estate, who are waiting for this date before making a decision on moving forward. And if the rates cut, assuming they're still well employed, they're not going to not purchase because other people lost their jobs. They're probably still going to buy, which means that your market could see a little bit of jet fuel, at least temporarily. Now, I know some people will be like, oh, that's bull crap. You're trying to pump the market. That's not what I'm doing here. I'm telling you that is human psychology. That is how the market works. And that is what people tend to do, especially historically speaking. At the end of the day, I don't like to celebrate job losses, but I don't ignore the signals. Economic tragedy is not what we all want to see, but successful investors don't ignore opportunity because they don't like how it was created. And there are some that are out there that are suggesting we see real estate in 2025 Q4 go down. Others are saying this is the beginning of the bottom of the cycle, and you could get caught missing out if you don't at least get in the market in some areas and some property types, not all. Please be very, very clear. I'm not suggesting this is everywhere. Economic cycles themselves are brutal. They're not fair. You can either participate from a strategic standpoint, whether it's your own mortgage or buying a property, or you can get steamrolled. It's up to you to choose how you participate. And the market really doesn't give a crap how you feel. Know your feelings. It cares the data, the probability, and the action. So, from a strategy perspective, what I would do is I would position myself for multiple rate cuts, half at least, maybe three points based on what the market's projecting, and not just the September relief that we're seeing. Over the next 2 weeks is your prime negotiation if you want to go variable to get the best terms on a variable rate mortgage. And realistically, potentially, if the market takes off, take advantage of the fact that a lot of people are waiting for this date to buy that property. Believe it or not, depending on what market you're in, unless you're sitting in this real estate market every single day, you're not seeing what I'm seeing. And I am actually seeing certain areas and cities and communities be competitive and be well. Like, we've had nonstop accepted offers coming in the door for the better part of the last 10 days. And I don't know if that coincides with BC long day weekend, but the market is picking up again. People are acting again. And I'm not going to suggest prices skyrocket. But again, this could be a situation where you just pay more for waiting, wait and see. I think the truth is you have more negotiating power now, and you probably will continue to have more negotiating power. But again, with that date in mind, you could lose some of that on September 17th, possibly. If we get the cuts the market expects, we could see prime at 4.2% on a variable rate. And so if you can handle your monthly payments right now, like back to the variable rate conversation, just went off track here. If you go variable right now and you have a really good reason to believe that rates are going to go down 75 points, there's a good reason to believe that you're going to be in the mid threes on variable rates for anything that you secure today for most mortgage products. That's not a bad play for someone who's actually well qualified. So if we look at this from a timeline perspective based on what the markets are projecting and nothing else, think of this as phases. Phase one is going to be September 17th. Phase two is going to be additional cuts, possibly by April, but a high probability. And then the phase three is going to be a stabilization at that new low. That new low could be 2% or 2.25% on the overnight rate, which could mean that ultimately you're in a position where the rate market stays lower for longer than expected, or at least per the projections for the last little while. If you're going to go fixed, which also isn't a bad idea, there's some great negotiation right now in place. If you're going to go variable, as I mentioned, try to get those discounts in, get it locked in before September 17th, before all the lenders reprice their loans. Sellers are still pricing properties based on the current rate environment, and buyers who understand what's coming up probably have this 2-week information advantage, but it'll be depending on how many people actually understand what's happening and the impact on the marketplace. So, for a few things, what's some takeaways that you need to consider from this information? Let's be brutally honest. You can't wait for the rate cut to get pre-approved. Lenders are qualifying you at current rates and current stress tests. The policy has not changed yet, just expectations. And the truth is, like, people want 100% certainty before acting. So there's going to be a crap load of people that are going to wait for that date because they want to see the number actually physically change. But this is about as good as the data actually gets. If you need absolute certainty, you're probably going to pay a little bit more than you have to if you go variable, specifically because of the discount, not because of where the prime is going. Okay. And the thing is, 66,000 jobs don't just magically reappear. If anything, additional economic data will probably reinforce the case for any cutting. So my suggestion, get pre-approved now or approved today. You should get approved because pre-approval rates are higher at today's qualifying rates, and use the next 2 weeks to position yourself and not scramble or refinance. Get that variable rate locked in today if that's the direction you're going. I want to be hyper clear. I'm not making a case for everybody to go variable here. I'm making a case for those who were going to go variable or wanted to go variable to do so before the discounts change. And if you're making a change right now and you're looking to buy a property, there is a likely possibility, especially if you can negotiate until after September 17th, but there's a likely possibility that you're going to get a good value on a home today that people might not offer after September 17th, because we've seen this historically occur. When the rate cuts happen, every seller seems to think they can get more for their property. So you might have more negotiating power for the next couple of weeks as well. Lenders are not reactive, they're pretty proactive, so they're going to adjust their policies right after the announcement. So we'll see what happens and what that looks like there. Friday's shift wasn't just another economic data release. The jobs data report was a moment that I think we're going to look back and say BOC's hand just got forced. Everything that seemed uncertain about September 17th was all of a sudden obvious. This isn't about me making any predictions in this case or hoping for outcomes. This is a mathematical probability, which is backed by an economic catastrophe that the market is providing feedback on a significant certainty. And while everybody is still processing this information, you've got the ability now to think and act ahead of time to know exactly what you can do or what you want to do. And there's this unique and interesting window that you can take advantage of moving forward. So if you want to position yourself ahead of this instead of just reacting while everyone else is trying to figure it out, let's talk strategy. Contact me and we'll build out a strategy session where we'll build out your plan for September 17th or beyond and the easing cycle that happens before. And if you found this information useful, make sure to subscribe, rate the video podcast, give me a comment, whatever you'd like to do, and let's get connected and have a continued conversation. I'll see you on the next one.